When gold went from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. That's a heavy lift. And from 3,000 to 4,000, that's a 33% increase. That's still a big lift. Now we're at 5,000. But when you go from 9,000 to 10,000, that's only 11% because you're working off a much higher base.
I see what you mean, yeah.
And when you go from 19,000 to 20,000, that's only a little over 5%. So the point being, these $1,000 leaps get easier because you're working off a higher base. So what's going to happen?
As gold ascends to higher valuations, the market resistance to each subsequent $1,000 milestone diminishes mathematically. While the initial move from $2,000 to $3,000 required a massive 50% capital influx, a heavy lift for any asset, a jump from $9,000 to $10,000 represents only an 11% shift. This base effect implies that as the currency debases, the metal's nominal price can accelerate rapidly, making five-figure targets far less radical than they appear in linear terms. Jim Rickards, a renowned economist and best-selling author, explains this momentum dynamic. The psychological barrier of expensive gold is an illusion created by looking at nominal dollars rather than percentages. Once the metal clears the initial heavy lifting of the lower thousands, the path to $20,000 becomes surprisingly frictionless, requiring just a fraction of the buying power needed for previous rallies. This acceleration suggests that the most explosive phase of the bull market may occur at the highest price levels. Now, we present the clips from Jim Rickards' interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold is going to go a lot higher. And I get a form of that question a lot, Julia, because people say, hey, Jim, you said to buy gold when it was 1,200 or 1,300. I should have listened to you. I didn't. It's getting close to 5,000. I missed the boat. And my answer is, no, you missed $3,000 or $4,000, but you didn't miss the boat. This has much further to run. And it's not a top. It's somewhere near a top. And it's going to go, well, I can easily see it going to $10,000, but that's not even a stretch. That's pretty straightforward. $25,000 or higher, yes. But let me give you some concrete math and analysis behind that, because anybody can throw out a big number, and they're out there, they're on podcasts or whatever. It's gold 25,000, but you need to know why. And there are a couple of things in play here. Number one, in January 1971, gold was $35 an ounce. In January 1980, it was $800 an ounce. That's a 2,700% increase in 9 years. If that happened again, I'm not forecasting this. I'm just saying it happened. And if it happened again, gold would be $100,000 an ounce. When gold goes from $35 an ounce to $800 an ounce, which it did, you can say, oh, the price of gold went up. Yeah. But if you hold gold as your constant, in other words, what's the dollar worth by weight of gold? Don't ask what gold is worth in dollars. Ask what the dollar's worth by weight of gold. It's just the inverse.
Okay.
The same math. The answer is that was a 94% devaluation of the dollar. The dollar lost 94% of its value measured by weight of gold. And people today are looking around like, hey, the dollar's going to, it's the crack up of the dollar's going to collapse, et cetera. But they look at the currency market. That's not the right way to think about it, because all those currencies are in the same boat. For example, what's a euro worth in dollars? That's the question. The answer is about $1.16. So 1 euro equals $1.16. Guess what the euro was worth in the year 2000 when it was first issued? $1.16. In other words, it hasn't changed in 25 years. Now, it's gone up and down. It was $1.60. It was 80 cents. It fluctuates. There's volatility. You can make or lose money. I'm not saying it's constant. It's not. But the fact is, there's no collapse of the dollar there. The euro dollar cross rate today is exactly where it was 25 years ago. That's not where you're going to see the collapse. It's not going to be in the currency market. It's going to be in the gold market. And so when people say the price of gold goes up, I get it. But, if you have a gold coin, you put it in a drawer and you close it and you go away for a year and you come back and you open the drawer, it's still a gold coin. It didn't multiply. It didn't do anything. The gold is the constant. It's the value of the dollar that's going down. Okay. So when the dollar price of gold goes up, the way I think about it, the U.S. dollar is collapsing. The
purchasing power of it.
Of the dollar in terms of weight of gold.
Oh,
that's the right way to think about it.
That is so fascinating. Okay.
So with that in mind, using that as a metric, when did the dollar collapse? So in the 1970s, in gold, it lost about 94% of its value. If that happened again, I'm not saying it will, but if it does, gold would be $100,000 an ounce. So if I say $100,000 an ounce, people are like, oh, Jim, you're crazy. What are you talking about? And my answer is, it happened before.
Right.
Okay. Now, there's another phenomena, a little more down to earth, and we'll tap into behavioral psychology. Because in behavioral psychology, there's a big science, Daniel Kahneman and Tversky and Dan Ariely and a few other leaders in this field. And they've identified a whole list of biases. We're just human. We have biases and instincts, and we can't get rid of them, but it's good to know what they are. But one of them is called anchoring. And anchoring means we get a number in our head, we get an idea in our head, and we can't get rid of it. And we begin to filter everything we see through that idea. That affects everything we think. So as applied to gold. So let's just say you have 50 ounces of gold and it goes up $1,000 an ounce. You just made $50,000. I mean, that's real. It goes up another $1,000 an ounce. You just made another $50,000, and so on. Every time it goes up $1,000 an ounce, you made another $50,000. Well, but you kind of get anchored on the $1,000 jump and the 50 ounces and the $50,000. But what people lose sight of is that each $1,000 leap is easier than the one before, a lot easier. So, for example, when gold went from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. That's a heavy lift. And from 3,000 to 4,000, that's a 33% increase. That's still a big lift. Now we're at 5,000. But when you go from 9,000 to 10,000, that's only 11% because you're working off a much higher base.
I see what you mean, yeah.
And when you go from 19,000 to 20,000, that's only a little over 5%. So the point being, these $1,000 leaps get easier because you're working off a higher base. So what's going to happen? Gold's, it's made its way to 5,000, not quite there yet, but it'll be there, very shortly. And it's going to, take a while to get to 6, but it's going to go 7, 8, 9, 10 really fast for the reason I just mentioned.
Investors fearing they have missed the boat at current levels are ignoring a critical historical precedent. Between 1971 and 1980, gold skyrocketed 20s and 700%, a move that today would imply a theoretical price of $100,000 per ounce. This trajectory doesn't reflect an increase in gold's intrinsic value, but rather a 94% collapse in the dollar's purchasing power. While currency markets show the euro and dollar trading in a tight range for decades, this stability is an illusion. Both are sinking simultaneously against the only true constant, gold. Behavioral psychology suggests investors suffer from anchoring, fixating on nominal $1,000 price jumps. However, the base effect dictates that these leaps become significantly easier over time. While the move from $2,000 to $3,000 required a massive 50% capital influx, a jump from $9,000 to $10,000 requires only an 11% shift. As the price base expands, the resistance to higher milestones diminishes, suggesting the ascent from $6,000 to $10,000 could occur with shocking speed. Let's get back to the interview.
Central banks flipped from net sellers to net buyers. So from 1970 to 2010, central banks were net sellers. U.S. dumped 1,000 tons in the 70s. UK sold a third of the gold at the bottom. It was $250 an ounce. That's when they sold. Nice going. The Swiss sold 1,000 tons in the early 2000s. The IMF sold 400 tons in 2010, and that was it. Then, since then, central banks have switched to net buyers. Now, it's not all the same central banks. The buyers are Russia, China, Vietnam, Japan, Iran. They're non-transparent, probably illegal, but Iran's a buyer. Turkey's a big buyer, Brazil, etc. So, but mining output has been flat. It's not collapsing. I'm not saying peak gold, but it's been constant at about 4,000 tons a year. Little fluctuations, but not big ones. Well, first week of economics, 101. If supply is constant, demand is going up, the price is going to go up. That's how the market adjusts. So, and that makes it very interesting for a gold investor because no guarantees, but when you have a dedicated buyer and a smart buyer, meaning they I hate to use cliches, but they'll buy the dips. Central banks don't want to disrupt the market, but they want to keep buying. So if they see a little dip, they'll come in and buy. They say, here's an opportunity. Well, you're putting an informal floor under the price
You
of
have
gold.
support, yeah.
Right. So that's what I call an asymmetric trade. You have limited downside and unlimited upside. Those are the best kinds of trades because you don't automatically make money, but you have a chance to make a lot of money, but your risk of loss is relatively low because of the central bank. So that plus the supply demand equation and flat supply give the gold market a really good foundation. By itself, that will not send gold to the moon, but it does give it a really solid foundation. Now, what else is going on? At the beginning of the war in Ukraine, so the Russian special military operation, February 2022, President Biden piled on all these sanctions on Russia, and they kept going. But one of the things they did that's a big deal, they froze, there were $200 billion of Russian assets that were on deposit in a place called Euroclear in Brussels. It's it's a clearinghouse custodian. So where did Russia get the securities? Well, they sold oil. They got paid in dollars. They bought treasury securities of various maturities. Their big mistake was trusting the United States. But we froze those immediately. It was $200 billion. Now, this was 4 years ago. So most of those securities have matured in the meantime. But it's a big pile of cash. The money's still there. Now, the EU and NATO, the US has been a little bit involved. They got this cockamamie scheme where they want to borrow, $100 billion or more on the bond market, give the money to Ukraine to fight the Russians, and collateralize the loan with these frozen Russian assets that I described. And then the theory is when Ukraine wins the war, Russia will have to pay reparations as a losing power, and that money will be used to pay the loan back, and you won't have to touch the assets. That's the plan, but everything I said about it is completely wrong. Russia's not going to lose the war. They're going to win the war. Russia's not going to pay reparations. They're going to extract wealth from Ukraine. The loan's going to go into default, and you're going to have to turn to the assets and steal them, in effect, to pay the bondholders. Now, that hasn't happened yet, but it's just in the air. But the rest of the world is watching. Saudi Arabia, Taiwan, Japan, Mexico, they're saying, hey, what if the United States doesn't like what I'm doing? Are they going to freeze my assets? And so this has caused a move away from treasuries. Now, to be clear, they're not dumping all their treasuries, but at the margin, as they add reserves or as old treasuries mature, they're buying gold. So the effort to freeze and steal the Russian assets has given a reason to countries around the world to say, well, what else are you going to do? The problem is there aren't many alternatives. Like if you don't like treasuries, do you want to buy Italian debt, Japanese debt, German, maybe? Those markets aren't that big, by the way. They're Italy, Japan, and Germany are like the second, third, and fourth largest sovereign debt markets after the United States, but they're nowhere close to what the United States has. And Italy, we don't have to tell you this, they're not famous for fiscal prudence. Japan's debt, we talked earlier about debt to GDP ratios. I said the U.S. was all-time high at about 125%. Japan is 300%. So you're rushing into JGBs? I don't think so. But gold is an alternative. And so this is another driver of gold. And then finally, people fear inflation. We're not going to get inflation. We're going to get deflation.
But gold does well in both environments. I learned that in your book.
That's correct. That's another thing that people don't really understand very well because they think of it as an inflation hedge, and it can be an inflation hedge. The correlation is a little lower than people realize, but at the margin, yeah, gold is a decent inflation hedge. But gold does very well in deflation. In the Great Depression, 1929 to 1933, well, lasted longer, but just take that period, the worst part of the Depression. It was the longest sustained period of deflation in U.S. economic history, and gold went up 75%. It went from $20.67 an ounce to $35 an ounce. It was an almost 75% increase in a period of deflation. And there are complicated reasons for that, having to do with the fact that inflation favors the debtor and hurts the creditor. So you lend me money, and we have a lot of inflation. And I say, hey, Julie, here's your money back. Good luck buying a loaf of bread. It's not worth very much. Yeah. So the debtor wins in inflation because I get to pay you back in cheaper dollars. In deflation, it's the opposite. The creditor wins. So you lend me money, prices go down. When prices go down, the value of the dollar goes up. You can buy more stuff for the same dollar. So as a debtor, this becomes more and more onerous. You're sitting there saying, hey, my loan is worth more in real terms because of deflation. But I'm sitting there saying, I got to pay Julia back more in real terms. And that lasts for a while. But then what happens is I walk away. The debtors default. And I'm like, sorry, Julia, see you later. I'm going to get I'm filing for bankruptcy. I'm going to sleep in tomorrow and good luck. So what happens is the debt goes from the original debtor, who then just goes bankrupt and walks away, to the bank that you basically, if you're the bank that lent me the money and I walk away, now all of a sudden you don't have a higher real value loan. You have a bad debt, and this erodes your capital, and you're going to lend less. This is how you get into a depressionary cycle. So in that world, people look for something that's not going to lose value. The best performing stock on the New York Stock Exchange from 1929 to 1933 was Homestake Mining. Homestake Mining was the largest gold mine in the world. Foundation of the Hearst family fortune, by the way. Huh. So William Randolph Hearst III or whoever's around.
I did not know that.
Yeah, George Hearst found the mine with some partners in the late 19th century. He either like bought out or killed his partners, kind of ruthless guy, but he ended up with the whole mine. But it was the largest gold mine in the world for a long period of time. Mm-hmm. But they went public, and that stock outperformed, when every other stock was crashing 80%, that stock did well.
Global central banks have executed a historic pivot, transitioning from net sellers to aggressive buyers, effectively placing a permanent floor under the gold price. With global mining output stagnant at approximately 4,000 tons per year, this opaque institutional accumulation, led by non-transparent nations, establishes a structural supply-demand imbalance that creates a classic asymmetric trade with limited downside. The weaponization of the financial system, exemplified by the freezing of $200 billion in Russian assets, has signaled to sovereign nations that U.S. treasuries are no longer risk-free, prompting a defensive rotation into bullion. Furthermore, history confirms gold as a premier hedge against deflation, not just inflation. During the Great Depression, as the credit system imploded and debtors defaulted, gold rose 75%. In that environment, mining stocks like Homestake outperformed the entire crashing market, proving that hard assets thrive precisely when the paper system dissolves. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.